Oil prices have been on a wild ride in recent months, with a 44% decline from their peak in early October to their bottom in December. Not surprisingly, as the oil market fell out of bed, we saw a tremendous upward spike in implied volatility on West Texas Intermediate crude options. Prior to this big move in late September and early October, WTI options were trading at around 23% implied volatility. And as the market sold off, those options went up to more like 40 to 50% implied volatility. And as of mid-January, are still trading between 35 and 40% implied vol. Now, what's interesting about this current level of implied volatility is it's very similar to where the oil market's implied vol was trading back in 2014, 15, and 16. We had a much bigger move in oil prices. That time, oil prices didn't merely fall 44%, they fell 76% as the market fell from $90 per barrel to around $26 per barrel. The oil market seems very out of joint early this year, expecting tremendous uncertainty across a tremendous range of options. It's not just 30 days that are trading at that level. It's also true of the 60s, 90s, even to 360-day options. But one question that we have is, can the oil market maintain this level of implied volatility? And we think that these implied vols can only last if there continue to be strong directional moves in oil prices. So for example, if oil prices were to go back down and retest or even break their recent lows to the downside, that could be very bullish for implied volatility on oil options. Now, the argument in favor of that is that U.S. production continues to rise, and the global economy, the U.S., China, Japan, Western Europe, all appear to be slowing. That could be pretty bearish for oil. The upside case for oil is mainly geopolitical risk. There's a lot of unresolved conflicts in the world, including Syria, Afghanistan, and Yemen, that involve various degrees of participation from Iran and Saudi Arabia. The U.S. continues to ratchet up pressure on Iran as well. Geopolitical risk could send oil prices soaring. That would also potentially be quite bullish for implied volatility. But maybe the most likely scenario is that oil begins to range trade once again. And if oil range trades, it's going to be very hard to maintain those high levels of implied volatility. And the option markets might calm down, and the volatility might go a considerable degree south. I'm Eric Norland, a senior economist for the CME Group.